Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Oracle.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. For Oracle right now, the core story, it's not really about traditional software anymore.
Not at all.
It's all about this massive high-speed transformation that's being driven entirely by, the demand for AI infrastructure.
Right. And if we unpack those latest results, they really do back up that narrative. Overall revenue for Q2 fiscal 26 hit $16.1 billion, which is a solid 14% jump.
It is, but the real power, as you said, is under the hood.
So where did it come from?
The cloud segment. That's the key differentiator.
Right.
Cloud revenues were $8.0 billion, up 34%. But even that number, you have to break it down.
Because you've got two different stories happening at once, right? The infrastructure side versus the application side.
Exactly. The cloud infrastructure, or OCI, that's the rocket fuel. That segment grew a phenomenal of 66 to 68% year over year.
60%.
Hitting $4.1 billion. This is the AI backbone.
And the application side.
That grew a more, predictable 11% to $3.9 billion. That split tells a whole story of where the market's money is going right now.
Okay, but here's the number that really, it just jumped off the page for me. The one that signals their future strategy.
Let me guess, the RPO.
The remaining performance obligations. For anyone listening, that's the total value of revenue they have locked in from contracts that are already signed.
And it wasn't just a bump. It surged 438% year over year.
To an astronomical $523 billion.
$500 billion.
$500 billion. To put that in perspective for you, that's roughly 8 years of their current total annual revenue already locked in.
And it speaks volumes about who they're signing these deals with. Huge multi-year contracts with AI heavyweights like Meta and NVIDIA.
That isn't just speculation then. That's guaranteed future business.
Absolutely. That RPO figure gives them this incredible long-term revenue visibility, which is why management is so confident.
And that confidence is reflected in their guidance, I assume.
It is. For the full fiscal year 2026, they're targeting about $67 billion in total revenue. That's about 16 to 17% overall growth.
But the real focus is OCI.
The real focus is OCI. They expect revenue there to accelerate to $18 billion for the fiscal year.
Which would be what, year over year?
That would be a staggering 77% year over year growth. So they're accelerating into the demand, not just keeping up with it.
That's phenomenal growth, but it brings up the big question. What's stopping the huge competitors, AWS, Azure, Google Cloud, from just eating their lunch? What's the moat here?
Well, there are two key factors. First, it's the high switching costs. They're rooted in Oracle's decades of dominance in enterprise databases.
So once you're in, you're kind of locked into their whole tech stack.
To a large extent, yes. Migrating those massive enterprise data sets is incredibly difficult and expensive. But the second factor is, I think, even more genius.
And that is?
Their multi-cloud strategy. They aren't trying to force clients to use OCI exclusively. Instead, they're positioning it as the layer that connects all the other clouds.
The integrator.
Exactly. And the numbers prove it's working. Their multi-cloud database business has seen, 817% growth? They have 71 joint data centers globally now.
And there was a fascinating detail about their hardware strategy, too, the chip-neutral approach.
Yes. That gives them incredible agility. In a world where AI chips are the main bottleneck, not being tied to just one manufacturer is a huge advantage. It lets them secure the best hardware from anyone.
And they're backing that up with specific partnerships, like with AMD for the 2026 Helios racks.
Absolutely. It ensures they can actually execute on that $500 billion backlog.
Okay, let's pivot to the cost of all this ambition. If they're expanding this aggressively, there has to be a financial cost, right? The RPO is future money, but they need cash today.
That raises a really important question. It's the critical trade-off here. The balance sheet shows strong cash generation, yes, but CapEx is soaring.
How much are we talking?
They're committing $50 billion for this AI infrastructure build-out.
$50 billion. That's a massive market-defining investment. So what does that do to their cash flow?
Well, it means free cash flow is expected to show a deficit temporarily. They are prioritizing decades of future revenue over immediate FCF.
So is this debt a red flag?
It's a calculated risk, a trade-off. Yes, debt has increased to fund the 211 regions and 72 multi-cloud data centers, but
they have the RPO.
Exactly. That massive $523 billion RPO acts as this huge financial cushion. They're spending the $50 billion to fulfill existing locked-in contracts. It's not speculative,
And they're still rewarding shareholders.
which is another sign of confidence. They hiked the dividend by 25% to 50 cents quarterly. They're saying we can do both.
All right, so let's connect all this to the stock price. How is the market reacting? How is the stock trading?
It's showing real resilience. The shares ticked up after earnings, and it looks like it's forming higher lows. The key support level to watch is right around $280.
And what about the momentum indicators? Are they constructive?
Highly constructive. The stock is trading above both its 50-day and 200-day moving averages, what technical traders call a golden cross,
A bullish signal.
a very bullish signal. And the NCD is hinting at a bullish divergence that's tied directly to that huge RPO number we talked about.
And what's the smart money doing? Are institutions buying this story?
They are. We saw a cluster of institutional accumulation last quarter. Firms like DuPont Capital, Yarbrough, Miracle Mile, all of them boosted their stakes.
I did see some insider selling, though.
There was some, about $39 million over 90 days. But the institutional buying and that strong earnings beat seem to be offsetting any nervousness from that.
So looking ahead now, what are the immediate catalysts we should be
You know,
watching?
well, on the calendar, January 9th is the dividend record date for that new 50-cent payout.
And macro-wise?
The January 9th jobs data release could be big. If it fuels rate cut expectations, you often see money rotate toward high-growth, high-capex names like this one.
And the next big report from the company itself?
That'll be the Q3 report in mid-March. They're guiding for revenue growth to stay strong, somewhere between 16 and 18%.
We also hear some whispers about potential projects, right?
We do. There's speculative talk about an internal Stargate project for AI cloud, and of course the ongoing talk around the TikTok US spinoff.
But the OpenAI data center project is confirmed.
That is confirmed to be on track, yes.
Yeah.
A major signal of their deep collaboration in the AI space.
Okay, let's play devil's advocate. Let's unpack the biggest risk. What's the bear case?
The top risk is, and has to be, the FCF deficit and the debt from that $50 billion CapEx plan. It all comes down to execution.
And what if AI demand, globally were to suddenly slow down?
That's the scenario that would put real pressure on their stability. But again, that's where the existing $523 billion RPO acts as the main counterargument. It makes the risk more manageable.
So when you put it all together, what does this mean for you, the listener? The picture seems clear. This is a company in a full-blown strategic pivot to become an AI infrastructure power player.
And that pivot is being fueled by these massive multi-year deals, all validated by that incredible RPO number. It's a high-stakes, long-term play on the future of computing.
The scale of the investment is just fascinating.
It is. Analysts who are bullish see huge long-term potential here. Some estimates are pointing toward $225 billion in revenue by 2030, all leveraging those high switching costs.
So we encourage you to look closely at the implications of this shift to AI-specific data centers.
Yeah.
The provocative thought we want to leave you with is this. If Oracle pulls this off, does the sheer scale of their investment mean we could see a fundamental redefinition of what a tech giant looks like in the next decade, outside of the usual big three? If you found this useful, please subscribe to Smart Wealth with Joshua for more daily stock analysis.